evening and welcome to the FITT Show. Financial information for today and tomorrow. I'm Bobby P. Kinzer.
And I'm Thomas Doty.
And we are the FITT Show. Financial information for today and tomorrow. Welcome everybody around the country and around the world. Thank you for being present today. It's our 155th show. I'd like to thank everybody who's been tuning in and hope that you all are sharing this information to your family and colleagues and friends. This has been a good run, Dote. How you doing today?
Man, I'm doing fantastic.
That is awesome, man. That is awesome. I'm doing actually great too, Dote. We had a good show last week, Understanding Asset Allocation, which we got, hope that was beneficial to everybody. And this week, we're going to talk about financial rules of thumb.
Hey, Bob, and I got a couple of questions that people were a little confused about the difference between the two.
Right.
Just to make sure you understand, when you talk about asset allocation, you're talking about the different classes of investments, like where you can put your money, stocks, bonds, fixed instruments, or cryptocurrency or commodities. Diversification refers to diversifying or choosing different assets or different types of stocks. Like you, in your asset allocation of stocks, you may want to get stocks in different fields. You may want to get stocks from different parts of the world in order to have diversification. So I hope that's clear, the difference between asset allocation and diversification. Asset allocation is the broad umbrella of the type of instruments you can buy. Diversification is how you manage your portfolio of those same products.
Right. And one another example could be as far as asset classes, you can have fruit, you can have cars, but there's different kinds of fruit within fruit. There's different kind of cars within cars. That's the diversification within an asset class. So I'm glad you did that, though, because we did have some questions about that. So thank you. That was good that you brought that up again. But let's get into one of well, wait a minute. Make sure first you click on the button as you can see right there. And also make sure you put comments in the comment box, because we do like to make this interactive. And the way that we can make this virtual studio interactive is that you put any questions you have, any statements you have, or any ideas you have in the comment box. And plus that helps us gain more traction to people on Facebook. I myself have over 2,500 followers, but how Facebook does it, they only let it out to a certain amount. And the more you put comments and the more you click on the like button and the heart button, the more they open it up to people. I don't know why they do that, but that's definitely what they do. So if you can make sure you do that, we would appreciate that 1,000%. So, Dope.
Yes, sir.
What everybody likes is the way we start the top of the show with the number one topic of the FITT Show. And you are considered the guru of giving us the information on the stock market. So let's start with the stock market update. And don't you be playing around. We want some good news this week.
Hey, well, I don't have bad news.
Oh, okay. That's a start.
It's been a quiet week. The S&P and NASDAQ were both at record highs, and they took a little hit today. But overall for the week, we're still positive. The S&P is up almost 1%, and the NASDAQ is up just slightly. Took a big hit today, but I mean, it's bound to happen. It's kind of naive to think the stock market is just going to always just go up, up, up. It's been going really, really well this year, and hopefully you guys are partaking in that in this rally. Microsoft's up 4 points. It's funny. It's the most valuable company in terms of capitalization. Microsoft and NVIDIA actually passed them, but then Nvidia went back down. So now Microsoft's back #1, and Nvidia's #2. Tesla's flat for the week. It's Elon Musk is just he's up and down. One week they're doing good. They're bringing out their self-driving, their robo-taxis, and so that's supposed to be a big plus. They've announced that they're going to have a $25,000 electric vehicle. That's been a big plus. But they're still having issues in China, and Elon Musk just creates issues. Apple down slightly, but it had been growing like crazy once they announced their AI plans, and it's up in record territory, up in all-time high territory. So that's a good thing, even though it's down 4 for the week. Pfizer's flat. Still happy with my almost 6% dividend, but I wish we get a little movement there. And my Nvidia is still rolling. I'm still debating when I'm going to sell part of this. It's going up over 10 times for me, and it has done well. And I'm thinking about it, but again, I don't have any great ideas as far as what to buy, so I'm going to let it ride. The price targets are still being increased on Nvidia, but like anything else, it's not going to last forever. Google is up slightly. So all in all, it's not a bad week, no great news, but the rally continues. Hopefully, we'll get some positive news the rest of this week and going in next week in regards to interest rates and inflation and the whole thing. But hope you're in it.
David, I'd like to correct you, if you don't mind.
Certainly.
It is not your NVIDIA. It's now our NVIDIA.
You finally got in?
I jumped on the bandwagon a week ago, and I'm already up 10%. I'm already up 10%.
That's a good thing, man. That's a good thing.
I ain't lying. I ain't no fool.
Okay, our NVIDIA.
Yeah, gold is still rolling along, though. It's pretty interesting that gold, is holding because it's usually inverse with the stock market going up, but it's been holding, and silver has been up and holding the commodity side of things. So that's pretty interesting. But though the cryptocurrency market is taking a hit. It took a hit last week, and it's taking a more of a hit this week. The Bitcoin is down $1,695, down 3%. It's down to 64,952 Bitcoin. But I got in at 29,000 though in 2019. 2019 is I think when I got in at 29,000. So I'm still to the good.
Yeah, I'm up. I'm up about 3 times.
Yeah. Yes, but if you got in after like around 2020, when it went all the way down to, man, it went way down there, about 16,000, I think, though. So, yeah. So, but Ethereum is up $44. That's pretty interesting. That's the smart contracts, which supposed to be a little bit better structured, for your for cryptocurrency, because it has like a contract tied to it, and it's supposed to make it a little bit more, but it's up. Everybody else is down. And poor Dogecoin, Elon Musk and the guy from Cuban, it's been going down. It's down 14%. It's down to 12 cents. One time was up like, I think, $2, $3 at one time. So, like we say, hang in there. It's the long play when we start talking about cryptocurrency. So make sure you hold on, and then have an exit strategy. Know how to get out, should you need it. If you need it immediately, you need to understand what platforms you can trade it out of, because not every platform you can trade it out. You got Robinhood, you got Cash App, and there's many more, but not all of them will cash your cryptocurrency into dollars. You might have to go to 3 or 4 different sites to finally get it converted to dollars, and they'll take money from you every site you go to. So make sure you understand how to get out, how to cash out.
Hey, Bob, And just an update, remember I told you I put 15 grand into a gold fund.
Right.
Yeah. And it was up over 16, it got almost to 16.5, and now it's back down to about 15.8. I'm still up, but not as much as I was. But again, this is something I won't even look at again for another 3, 4, 5 years, and I'll look and see where it is then.
Interesting. Very, very interesting. But like I said, it's good to, like we talked about, asset allocation the other day and diversification. That's one of the things that we're trying to say. That way, you can sort of hedge against the market, because nobody knows what the market is going to do. Sorry about that. I just forgot to put my phone.
Bob, and the real key thing is, it's like if you are diversified, you may have something that will hit, which is obviously the goal. You want to have something that's doing well in most types of, or in different types of markets. So if you are well diversified, something should be going well even when a lot of things are going bad. And that's the main attribute of being diversified.
Yes, that's key. That's very key, though. So, let's get into our topic for today. Financial rules of thumb. What are we talking about there?
Yeah, and the whole thing with
Oh, no, I'm sorry. Before you go there, Modestine has a question. And Modestine said, I have a question about SIPC. That's the Securities Investment Protection Corporation, and investing in a brokerage account. What is your question, Modestine? We'd like to go ahead and cover it right now for you. Thought it was in there. But, SIPC is just what I told you. They are the company that insures stocks and bonds like that, brokerage accounts. And then I don't know what your question is about investing in brokerage accounts, but brokerage accounts, usually you got to put the money in an account, usually a money market, so that you can then sweep that account and trade. And if you use, online, they normally don't charge you. Brokerage firm normally, if you use the online and do it yourself, they don't choose you a fee. But people like T. Rowe Price, they'll charge you $9 up to a certain amount, which is a large amount. I think maybe $50,000 to $100,000. So, check that out. But yeah, Modestine, well, we'll wait till you come back. I thought you had the question in there. I just read it. But yeah, put your question in there, Modestine. Somebody else might learn from that. But yeah, Dope, let's talk about financial rules of thumb. What is that about?
When you're talking rule of thumb, you're talking about like general rules or things that are true most of the time. And when you're trying to put a financial plan together, it can be overwhelming. We talked about how much work it takes to create a plan and work it to make sure it's working, doing what you want it to do. And so you have all these rules of thumb that are just frameworks of things you should do, things you shouldn't do. And they're general in nature. They when you think about your own personal goals, those are really unique to you. Not it's hard to come up with a universal rule of thumb that's going to apply to everybody. So when you think of these, and what we're going to do is try to go through some of the rules of thumb and talk about some of the good things about them and some of the bad things about them. But remember, it has to be geared to you. For example, if you have a goal of buying a house, or you got to save to pay for your kids' education, you got to think about it more than just a goal. It's a means to an end. It's not, the goal isn't to buy a house. The goal should be to build wealth. And if you think about why you're buying a house, your reasons could possibly be, well, you got to pay to live anyway, so you may as well put something in value that's going into your pocket as opposed to paying the landlord. It might be to save on taxes. It might be the fact that you can get that house paid for, and then you don't have a have a house note anymore. But all those things are geared toward helping you build wealth. And so the house shouldn't be the goal. It should be the means to get to your goal. And so when you think about your goals and some of these rule of thumbs we're going to go through, these are just guidelines, and they might be able to help you achieve what you're trying to achieve.
So, Modestine is coming with a question, and you want to handle it, or you want me to handle it first?
What's the question?
Are brokerage accounts a good investment?
Well, a brokerage account is not an investment. It's where you keep your money, and with that money, you can make investments. Okay, so a brokerage account is no different than a regular bank account. It's just where you keep your cash. The only difference between a bank account and a brokerage account is with the brokerage account, you can buy stocks, you can buy bonds, you can buy crypto, you can buy gold, you can buy commodities. So don't look at the brokerage account as an investment. Look at what you do with the money in your brokerage account as the investment. I think you agree?
Yes, but in addition to that, a brokerage account is where you hold your stock certificates so you can trade in and out of stocks. Now you can elect to hold your stock certificates, right? Because you own the stock. But then when you go to make a trade, you're going to have to present your stock certificate to a brokerage firm to do the trade for you. So that's why you have a brokerage account, so you can trade in and out of stocks. And then in order to buy the stocks, you have to fund a brokerage account. You have to take the money from your bank and you can connect it to your brokerage account. And you'll say you want to buy $1,000 worth of NVIDIA. What you do, you link your bank account and you will request from the online brokerage account, right, to put $1,000 to your bank into the brokerage account. And they normally have a money market. The money market is usually, a dollar for dollar, right? So you put that in there and it's safe. And then if you want to buy the stock, then they do what they call, you sweep the account from your money market. You have money now to purchase the stock. That's how you're able to get. And that's the function of a brokerage account, so that you can purchase and you can buy in and out of stocks.
Yeah, and let me add to it. I keep the majority of my money in a brokerage, a bank, to pay bills, because I don't want to pay, and I can pay bills through my brokerage account. I just choose not to, because I'm trying to eliminate the possibility of fraud. So I don't use that account to have money going in and out. I put enough in my bank account just to pay my bills, and I use my brokerage account for my investments and my savings. I don't keep any money in a bank, because a bank is not going to pay you a market rate of interest like a brokerage account will. If you look at a account at Charles Schwab or E-Trade or Fidelity or Vanguard, their money market account is going to be a competitive rate. And if you look at the rates that the bank pays, they are not going to be competitive. The banks make money by paying you a little bit and charging you a lot to borrow.
And using 90% of your money.
Yeah, and so I use the brokerage account for my investments. I use a bank account just to pay my bills. And in a perfect world, if I weren't worried about scams, I wouldn't even have a bank account. Banks really have no use for me. I have no use for banks. But because if I get scammed, I'd rather it happen in my bank account, where I have a minimum amount of money, versus in my brokerage account where I have a lot more money. So I hope that answers your question.
Yeah, and remember, the money markets is the lowest, one of the lowest risk securities that you have. Money markets usually around about, very low interest rates, and they're very safe. And banks have money markets also, but that's how
very low interest rate. They're competitive. I mean,
but they're not as good as the rate at a brokerage account. To your point, though,
you say money market. So when you say money market, brokerage account have money market account.
Yeah, but some banks have money markets also.
Right. So bank money markets aren't competitive.
But to your point, the bank money markets are still not as competitive as money market in a brokerage account.
Nothing in a bank is competitive.
Yes. So that's it. But that's why you have so they can hold your stock certificates. If you want to trade real quick, usually get that trade that day, or if it closed, you get it the next day. That's the main point of having a brokerage account, so you can trade in and out of stocks. So I hope that helped you, Modestine. Oh, she said, yep, thank you, guys.
Yeah,
Perfect.
but to your point, you can't buy a stock unless you have money in your brokerage.
In the brokerage account, yeah.
Even though it's 2 days now to settle. Okay, you have to have, supply the certificate within 2 days and have the cash within 2 days. But most brokerage accounts will not let you buy stocks unless you have an account with the funds available to trade.
Now you could go to T. Rowe Price institution, T. Rowe Price, and purchase there at T. Rowe Price. You can go there. But this is if you're trying to do stuff at home and online. That's why you can have a brokerage account. So great question, Modestine, because I hope that helps other people, because the thing is, you can just have that money sitting in the money market growing maybe 4, maybe 5%, because they're going to do better than the bank. And you can buy stocks or not. But when you go to buy stocks, you just sweep out of that account, and that's how you can buy stocks. So I hope everybody's listening, because y'all need to go out there, put some money in a broker's account. Most of you FDIC people, I've been using T. Rowe Price, because if I use it online, it's zero commission, So anyway, the thing about the rule of the thumb, investors may be familiar with a variety of rules of the thumb, financial rules of the thumb.
Rules of thumb.
Financial rules of the thumb. Rules of thumb, excuse me. And that, know that they're intended to help individuals learn, remember, and apply financial guidelines. But these rules of thumb address methods and procedures for saving, investing, purchasing a home, and planning for retirement. Now, although a rule of thumb may be appropriate for a wide audience, it may not apply universally to every individual and a unique set of circumstances. So the essence of personal finance is in the name, personal. It's about making informed decisions that pave the way to financial stability and success, on your terms. Now, financial rules of thumb are best viewed as basic tools for measuring your financial health, but they are no substitute for tailored financial planning. I want to share with you a couple of basic financial rules of thumb. This one right here, there's a couple of examples. A home purchase should cost less than an amount equal to 2.5 years of your annual income. Now remember, these are just basic measuring benchmarks. Now none of these are 100%, but these are basic rules of thumb, and you apply them accordingly. But it gives you a benchmark of where you could be. The other one is rule of thumb: save at least 10 to 15% of your take-home income for retirement. Have at least 5 times your gross salary in insurance death benefit. That may vary from person to person. Some people might think they only need 3 times, 2 times, 1 time, but that's all personal. But this is just basic rules of thumb. Pay off your high interest credit cards first. You should have an emergency fund equal to 6 months to 12 months worth of household expenses. Your age represents the percentage of bonds you should have in a portfolio. If you have 100%, if the total is 100% in bonds, if say you're 60 years old, then they're saying that you should have 60% of your portfolio in bonds. Now, your age subtracted from 100 represents the percentage of stocks you should have in your portfolio. And another rule of thumb: a basic balanced portfolio is considered 60% stocks and 40% bonds.
Yeah. But okay, let's go through a few that, and again, sometimes people see these rules of thumb and people think they're fact, and you'll hear a lot of the financial gurus be it Suze Orman or David Ramsey, and they'll feel strongly about a particular role. But again, they're talking in general terms for the average situation. But nobody's personal situation is average. There's always exceptions to everyone. So one of the things that a lot of people believe in is delaying Social Security, withdrawing from Social Security, delaying that as long as possible. Because you can start collecting at 62. And if you do, they can they start reducing how much you receive until you reach your full retirement age. Once you reach your full retirement age, the amount that you receive will go up about 8% a year for every year you delay up until age 70. Once you reach age 70, it will not go up any further than that. Make sure you understand that. And so for a lot of people, that's the way to do it, to wait until you're 70. If you have money to live on, you don't need it. You expect to live a long life, everything, and obviously nobody knows for sure how long they're going to live, but if you're fairly healthy, you don't have any underlying conditions, and you expect to live a long time, then it might be best for you to delay and maximize how much you get once you turn 70. And I told you, for me personally, I did a break-even analysis, and it basically said if I live past 77, I should have waited until 70. If I died before 77, I did better by getting my money now and having money in my pocket now. But even more so than that, I kind of looked at when I would be using the money. I'm thinking now is the time I'd be enjoying it, or between, I started taking mine at 66, my full retirement age, thinking I'm in good shape, I'm healthy, I can go enjoy it, spend it. And that's what I did. Again, that's a personal choice. It's different for everybody. But if you're in a situation where, again, you don't expect to live a long life, I know that's kind of crazy to say.
Or
But
morbid.
yeah, morbid to say, that's a good word. But and if you need the money, that's the overriding reason for taking it early. You don't have other assets to live on. You never want to go in debt by not, and you got Social Security to take. So again, it depends on your situation. In probably most cases, you're probably better off waiting to 70 and maximizing how much you receive.
Excuse me. Yeah, though that's that one sort of, I took mine early, but those 3 years sure came up pretty fast. Good Lord, I'm like, whoa. But I used the money because my break even was 72, I think. So here's another one. And I know some of y'all know this, but we need to reiterate this. Never take a loan from your 401k. Now, this is why, what you need to know. Withdrawing funds from your 401k before age 50 and a half incurs, obviously, a 10% penalty, unless it's an emergency withdrawal. And if you lose or leave your job, you have to repay the loan in a short period of time, typically 60 to 90 days. And then the remaining balance will be subject to 10% penalty and standard income taxes, too. So understand how each of your accounts supports your goals. Ensure that you're putting your funds toward their intended purpose and only deviate when it's absolutely needed. So when should you deviate from it? Let me talk about first why you need to follow it. Because once you got your basic needs covered, the 401k loan is not meant to be put down on higher mortgage payment or to fund a vacation. Withdrawals mean you have less saved for the future, and you miss out on compounding. That's the positive. You have the means to create an emergency fund. If you do, then that's better than trying to take it out of your 401k plan. Now, consider a savings account or money market fund for your emergency fund, just like we just talked about. Money markets. It's another way to place your money. Now, which is considered the gold standard for covering unexpected expenses, money markets. Now, when to break from this strategy? You need cash for a specific. Like those say, everybody's different. Everybody has different needs. And you might have a one-time need. When necessary, the 401k plan can provide a one-time cash infusion to fund an expense like a rental mortgage payment to prevent eviction or foreclosure, right? Another reason why you may break from this strategy is your only other option is a loan with a third party. Though you carry the burden of interest on your 401k, you'll pay it into your account rather than the bank. Now, if you're carrying high interest credit card debt, and let's say the average credit card debt you have is 15.78%. That's the average credit card. It definitely go higher than that. So you may choose to absorb your 401k plans, loans, penalty, and rid yourself of a double-digit credit card interest, especially since you're paying the interest on the 401k plan back to yourself.
Okay, the next one, I'll start off by saying I don't agree with it, but prioritize paying down your debt. Now, for some people, that's more of an emotional decision than a purely monetary decision. And remember, I'm a bean counter. I'm very cheap, and I look to maximize my money in every transaction I make. So I have a very small mortgage on my house, and the reason I took a mortgage is because I bought a new construction, and they were offering a $2,000 credit if you financed a mortgage through them. And at the time, the interest rates were 2.375, which is dirt cheap. And I always believe I can do better than that with money as opposed to using it to pay off a house. Another way of looking at it is Bob and I both buy the same house. It costs $500,000. Bob pays cash for his house. I get a mortgage for $400,000. So I have $400,000 of money to invest. And as the value of the house goes up, Bob's value of his house goes up, my value goes up. But Bob has a lot more money invested in the house. I have very little invested in the house because I have a mortgage. So true, I have to pay the mortgage, but if it's a very small amount, I'm looking at I can make money on that money as opposed to just having it sit in a house and not really earning you any money. And so, again, a lot of people find comfort in the fact that I don't have a mortgage, that I feel I can sleep better at night because I don't have a mortgage. And if that's how you feel, so be it, because you are the one that has to be satisfied with your decisions. For me, I would rather have some money at 2.375 that I can take and invest and do better than that. And plus the $2,000 at closing was incentive for me to get a mortgage also. And so again, it's a personal decision. And you may look at, if you're close to retirement, you just want to have that out of the way because maybe your income's going down from when you're working to being on Social Security, or if you have a pension. And so that may be why you want to get the house out the way. And again, you got to figure out what works for you. Some people look at a house as a tax write-off. They can write off the mortgage interest and the property tax. That may be a reason to have a mortgage. But you have to look at the whole ball of wax. Another thing to look at is if your equity is less than 20%, then you have to pay private mortgage insurance. And so if you pay your mortgage down to get your equity more than 20%, then you may be able to get the private mortgage insurance taking off of your house payment. That's more money in your pocket. So in those cases, it may make sense to do that, but it has to be something that you're comfortable with. If you got a real low interest rate, you can handle your loan payment, you're actively invested in the market, and you can do better than the mortgage, the rate on your mortgage, then maybe it ain't for you. So again, it all depends.
Yes, that's a good thing. It definitely depends, and this is what I try to make this point always because income, right? There's different kinds of income. You know, there's compensation income, and then there's passive income. Compensation income means you're working, you got a job, you're working for that money. But the name of the game that me and Dope want to always talk about with using the stock market as one tool is you want your money to work for you. And if you leave the money in the house, your money's not really working for you. I mean, I guess, you could say equity may be going, but that's not actually, cash money.
No, it's not working for you at all, Bob. It's not doing a thing for you.
And that's why I wanted to kind of couch it, but for real though, it's not. And the name of the game is you want your money to work for you. We're living longer. You want to have another bigger cushion when you get older, and I'm sure you want to pass money on to your children and your grandchildren. And the way to do is to have your money working for you, and that's why me and Dodo always talk about the stock market, because you just leave it there and don't do nothing. Just wait. Don't look at it for 5, 10, 15 years, and you look at it and see what your money have done for you. So just want to make that point. That's the key of having your money work for you. Let's talk a little bit about prioritizing diversification and investing. We talked about this last week when we talked about asset allocation. Now, it makes sense to have a plan for navigating different market environments. Morningstar, where we've gotten this report from, they talk about, you know, large cap stocks perform best during economic growth and bonds during low inflation. But diversification should help you feel like your goals are within reach and not make you worry about missing out on opportunity. That's why you want to have a good mix. Don't have all your eggs in one basket, feeling like somebody tell you, that the video is really doing well and you didn't invest in it and you think you lost out. It was the FOMO, fear of missing out. But this is one of the reasons why diversification is so important. You're investing over a short period of time. Diversification is the best way to ensure that even if certain asset classes experiences losses that you may you may not recover within your time horizon, you'll still come out ahead. Now, if you only invest in the single stocks, you can reduce specific stock risk by investing in equity funds that own a basket of securities. And it's better to use funds that are owned in a variety of asset classes. So make up for the potential net loss in the stock market. Now, when would it be different to go with this strategy? Now, you've been taking the same approach to diversification for a while, and correlations between asset classes change. Like one mix of investments won't behave the same in every environment. And you recognize this and realize this, then you're adding, or another reason, you're adding asset classes that don't serve any purpose. I know some people just buy stocks, and they're not buying them with any main purpose. Investments like real estate might seem great because they don't move in tandem with the broader markets, but their lows can be major, and that can be a hard to stick with that. Now, it's getting too complicated. They said research shows that 80% of the time, a 60-40% portfolio has better risk-adjusted returns than a portfolio with exposure to 11 asset classes. Diversification is so important, but you don't necessarily need an array of a special niche stocks like cryptocurrency or anything like that to see the benefits.
Okay, the next one is buy the dip. and if I knew how to do that, I'd certainly tell you guys how to do it.
Right.
And that's one. It sounds good. I mean, it's music to everybody's ears. Oh, I'm going to buy low, but nobody knows when the markets dip. Nobody knows when it's going to be at its lowest point. And this gets into timing the market, which we firmly don't believe in. And again, you don't know when it's going to be at the dip. We've always believed in buying consistently and constantly. And if you're using dollar cost average, when the prices are going up, you're buying less shares. When the prices are going down, you're buying more shares. Nobody has a crystal ball to know what's going to happen when the market's going to dip and when you should jump in. And so, don't even try. It's not. Guys who are experts have trouble doing that. Now, I'm sure you can find some examples where you see a company take a big hit and you realize that maybe it's an overreaction or something, and you have some extra money to throw at it. But even then, that's like buying a lottery ticket. So I would just firmly say, buy consistently. Don't try to time the market.
But I like to give it an exception, though.
What is it?
A situation like NVIDIA, which they had a stock split and the stock dipped down to 120.
Well, but again, the stock didn't dip. The price just changed. The value didn't change at all.
I understand, but the stock went from $1,200 to $120. I'm just saying.
No, you're giving the wrong impression. That's not true.
No, I'm just saying. Wait a minute, though. It did drop from 1,200 share to 120, and that's a lower price.
The value stayed the same. It just divided by 10. That's all you did.
No. The stock price changed.
Shares times 10. You divide the price by 10.
No. The stock price changed, though. The
value didn't change.
That's you're counting if you had owned the share, if you owned the stock. But if you didn't own the stock and you couldn't afford it at $1,200 a share, when it dropped to 120, that's the time that you might want to jump in and purchase it. That's all I'm saying.
We can agree to disagree because, a lot of firms do that. And that used to be very important. But now, since you can buy fractional shares of stock, that incentive to get it to 120 and now it's affordable. No, it was affordable at 1,200 or 1,200, but you could buy a fractional share, and the value is still the same. So there's not really a dip in the price. And when they're talking about buy at the dip, they're talking about when the value of the stock is going down.
Yeah, and I got you. It means when the stock value go down, the price of the stock goes down. But I'm just saying,
value didn't change.
I understand that, though, but the price of the stock changed, and that's why they had a stock split to make it affordable. And I'm saying some people who was thinking and listening to you about NVIDIA, and it kept on going up and going up, and they, oh man, I can't afford that. I can't afford that. And now it's at $120, well, that's $135 a share. That's one thing you might need to look at jumping in. But let's keep rolling. Okay. So now there's this rule that this guy came up with, Bill Bergens. It's called the 4% rule. Now, you should withdraw no more than 4% of your annually from your retirement portfolio. Now consider anticipate changes to your overall spending patterns. Research from Morningstar found that individuals often experience a decline in discretionary spending throughout the course of retirement as they become less active, though total costs, including healthcare expenses, follow a retirement, what they call spending smile pattern. Your spending goes down. Now think about income consistency as well as your desired lifestyle in retirement. Would a fixed or flexible withdrawal strategy better enable you to fulfill your goals? And that's something you need to think about. Now, all of this, if you want to prioritize a stable cash flow, so that you can do more things, The safe starting withdrawal rate fluctuate each year as the market environment changes. But researchers show that 4% or lower is typically a good yardstick for consistent income to take out of your um, retirement plan. Now, 20 to 40% of your portfolio, if it's in equities, in a down market, Morningstar shows that starting at 2% withdrawal, much less than the 4%, can be dangerous if you have, especially if you have all stocks, all equities. Now, you may want to leave more to your beneficiaries. Then reducing the withdrawal rate makes it more likely that you'll have funds to leave for your heirs. Now, when to deviate from the strategy? You're willing to employ a flexible withdrawal strategy. For example, not fully adjusting your withdrawal rate for inflation or taking less in down markets. These approaches inherently create cash flow volatility, but can also enlarge your starting and lifetime withdrawals if you just hold off. Now, guaranteed income will supply some household spending. If part of your income comes from Social Security or pension or annuity, changes in portfolio spending may be more tolerable.
Okay, the next one, this is one I firmly believe in, is maximize matching contribution to your employee's retirement savings plan. Now, there'd have to be very extenuating circumstances for you not to follow this. And a lot of companies have matches up to 6%, and some match less, some match more. And I always look at that as free money. I also look at that as part of your salary. If you aren't getting your full match, you are leaving money on the table. And you guys know how I feel about that. So it'd have to be a very, very good reason for you not to do that. And the only reason I could even think that would be close would be if you had a lot of high interest debt that you're trying to pay off, whether it's credit cards or student loans or something like that. Or you have an emergency need for cash that you can't have tied up in an employee savings plan. But again, those should be the exceptions as opposed to the rule. So this is one of the rules of thumb that, again, 99% of the time is probably right for most people.
We got a question from James Alexander. What's up, James? He said, what is the legitimacy of having AI, artificial intelligence, making the trades for you? And my take on it, I'll go first though. It's just like any other risk that you take, strategy. I mean, AI is supposed to be a tool to use. It's just like whoever you use as a financial advisor or not. You're taking a risk. I just don't know. I haven't used AI, but I know they do have AI and they use algorithms to help. But it's just like everything. No one, as me and Dote always say, no one, not even AI, can predict the market. So it's just upon you if you want to take that risk like any other thing. If you want to take the risk and buy stocks, you want to take the risk and buy cryptocurrency, that's on you. But it's still early to say, but what's your take on it, though?
Well, it's the thing they used to say when they first bought computers out was garbage in, garbage out. To put the information that you put all your, let's call it all your thoughts and principles into the AI so it can figure out what it needs to buy for you, it's going to be a considerable amount of work anyway. And so if you can lay all that information out, that information being your risk tolerance, your goals, your short-term plans, your long-term plans, where you feel comfortable investing, what type of vehicles you feel comfortable partaking in, then yeah, AI would probably come if you give it all the right information, it could probably do a very good job for you. And I would, as opposed to using that, I'm of the belief that just a simple mutual fund, if you, let's say you don't want to be involved in picking stocks, then I would suggest just a mutual fund that mirrors the S&P 500 or that mirrors some other sector of stock that you feel comfortable investing in. For example, it may be tech, it may be gold, it may be international companies. And that's kind of the same thing as far as somebody else or something else, some other vehicle you're using to pick where you invest. And so it's AI, but you have to supply a good amount of information in order for it to make that decision.
I want to talk for a minute, though, rule of thumb, which a lot of people don't pay attention to, but it can eat your money, eat your savings away. And that's prioritize hedges against inflation. Now, though worker salaries don't always keep pace with inflation, they typically see enough adjustments to help you maintain some purchasing power. If you get a raise each year, but you may not. You may need to be more concerned about preserving your purchasing power in retirement when assets are more fixed. But based on your desired timeline for starting portfolio withdrawals, you can identify how much of a priority inflation hedging, should be. For instance, if you have a lot of bonds, inflation is a greater threat to your bond-heavy portfolio than a stock-heavy one. Bond investors may choose to prioritize inflation protection with TIPS, Treasury Inflation Protected Securities. Now, you need funds in the short term, though an all-cash portfolio isn't a winning long-term strategy. It's a good way to ensure you have some funds accessible during an inflationary environment. Now, when to differ from this strategy, if you have an equity-heavy portfolio and a longer time horizon, stocks tend to be fairly resilient long-term inflation hedge because companies tend to have a certain amount of pricing power. They may be able to pass their increased expenses along to their customers or may be particularly dependent on the cost of raw materials to maintain their profit margins. Now, if you're considering a particular niche, like oil and gas or banks, returns on supposed inflation hedging asset classes like gold or cryptocurrency are very unpredictable. So don't start investing in niche asset classes purely in the interest of trying to protect yourself against inflation. Now, the other rule of thumb is the focus on inflation is causing you to ignore other portfolio risks. You really need to back up and realize that inflation hedging efforts shouldn't come at the expense of managing other risks like trying to manage against recessions and geopolitical tensions around the world.
Okay, another rule of thumb is hold 100 minus your age in stocks. And that's another one that I don't firmly believe in. But again, it has to be geared to your particular situation. And so this says if you're 60 years old, you should have 40%, only 40% of your investments in stock. And we always talked about how the average return on stocks has been 10% if you go back to like 1930. That's the average. Sometimes it's higher, sometimes it's lower, but the average return is 10%. That means your money doubles every 7 years if it holds to that average. And this is really intended for your retirement portfolio. And the thinking behind it is as you get older, you want to have less risk in your portfolio. And if that's the case for you, if you don't have other monies, you don't have a pension, or your Social Security is enough to pay on, so you need the money in your retirement account to live on, then that might be a reasonable rule of thumb to follow. But with people living so much longer, and Bob just talked about the damage that inflation can do to your portfolio, if you're not invested in the stock market, then you aren't going to be earning returns that are going to keep you ahead of inflation. So if again, I can think of very few situations where this would apply. And so if you're younger, if you're 40 years old and you're investing money that you won't need in the short term, I don't understand why you wouldn't put that more in stocks, or let's say more in riskier investments, because you have time for it to go up, even if you have the bear markets where it takes a hit, or you have something crazy happens like the pandemic and it takes a huge hit. If again, when the pandemic hit and the market fell off, if you needed money at that particular time, yeah, you were in trouble. But if you didn't and you left it sit, it came back even stronger than it was before the pandemic. And so, again, this is the one that I don't think, I don't believe in, but it depends on your own individual situation and your risk tolerance, how much you're willing to risk, whether you can sleep when the market's volatile or not.
Well, and like we say, these rules of thumb are just basic rules. They don't apply to everybody, but if you don't have anything other than that, it may not be bad. But it depends on your situation. Remember, personal money management is personal to you. Now, this one is a good one, though. Retirement is the end of work. What you need to know about that? This might seem obvious, of course. Retirement is the end of work. Well, what do you consider work? Retirement should be considered an on or off switch between being productive or not. It can just as easily give away to caregiving or, you know, walking a dog, doing dog setting. And there's so many other things that you could be doing. So, what is really considered work? Now, think about whether your goals might align with reframing retirement from the end of work to just a different kind of work. Like, if you need a break, you've been in the workforce for 30, 40 years, maybe you're not ready to think about more work. It's okay, take a break and not worry about the next project you have to do. You know, you're struggling to switch from savings to a spending mindset, what a lot of people have. Many retirees been spending so many years saving that they don't even have the mindset to spending, right? Many retirees struggle with giving themselves permission to start spending money that they spent decades accumulating. But recognizing the end of your work might help you accept why you're starting to use those funds. Now, when to deviate from this, structure will give you a sense of purpose. Retirement might be a good chance to turn your hobbies into work, which can provide purpose, but still feel like you're doing something different from work. Now, you may want to keep working. Retirement at 65 isn't the final test of whether you invested well enough during your life. Your choice to continue working can be driven by a multitude of factors, including your own lifestyle preferences.
Okay, hey, Bob, those are the rules of thumb that we've had, but we also have a list of common sense rules of thumb. And
Yeah, let's check them out.
Let's run through those right quick.
Let's see if some of y'all thought of these.
And these are just common sense to us anyway. This is how we feel anyway. Don't buy stupid stuff. What did I say, Bob? Don't spend money you have to buy things you don't need to impress people who don't care.
Yes, exactly.
And number two, if you carry a balance on your credit card, whatever it is you bought, you couldn't afford it because it's costing you way more than you can think because of interest costs. Don't take out loans that you don't need. Don't pay for money because you're basically paying for that money. So if you don't need it, don't pay extra for that money to buy that thing that you don't really need. Wait a week between deciding to make a purchase and actually buying it, especially if it's a big item, and really think about, do you really need it? Or is it something that you can do without, and that money could be better utilized somewhere else? De-link credit cards from online shopping sites. One reason you buy so much because it's so easy to do. Make it a little more difficult to buy things. Separate your money from emotions to the greatest extent possible. Be more pragmatic in your purchases and try to make solid decisions that really meet the goals of what you're trying to accomplish. And finally, you can't time the market. Don't try. You probably won't be successful at it. It's just like buying a lottery ticket. So those are rules of thumb that we believe in.
So with that dope, let's go to the summary and takeaways.
Okay. I'll start, Bob.
Okay, cool.
Know where you are. Understand what you have, what your ins and outs as far as your budget and your expenditures are. That's the best way to get started in moving forward, is understanding where you are now. Know what your debt level is, how you're going to get it paid off, credit score, know everything about your personal situation. That's the best place to get started in moving forward.
Next one is know where you're going. And that's very important. But like Doe said, first you got to know where you are. So, because if, me and Doe are going to Penn State and he's leaving from New Jersey and I'm leaving from Maryland, we've got the same destination, but it's a different route. So you need to know where you're going. And it's so important to have, and we talk about this all the time, of having a financial plan and having a financial horizon so that you can meet those targets. And remember, you can always adjust them. But you know those saying, shoot for the moon. If you miss, you fall upon the stars.
Okay. Know the rules of the game. This is one we talk about a lot. It's like last week we talked about, a couple of weeks ago, we talked about the fact that you pay a lower interest rate on dividends than you do on interest. So if you can get a stock that's paying you a dividend, maybe you're better off than having that money in a money market where you're getting interest and you're paying a higher interest rate. You got to understand the tax rules. You got to understand the rules of the game. You can't be playing touch when everybody else is playing tackle. And I firmly believe the rules are complicated to keep unsophisticated people poor and to make people who understand the rules rich or richer. So if you're going to be in this game of building wealth, you got to understand the rules, make sure you can maximize what you're trying to do, and all legally make sure you can build wealth that way, but you got to know the rules of the game.
And I always tell my coworkers, though, that the FDIC, they'll be complaining. I said, look, don't go to the coach and ask, it's a basketball game, and you ask them to put you in the game, you got a hockey mask on a hockey stick. Know the rules of the game. The last one is know what works for you. Like we said, financial rules of thumb, just general and basic rules. Doesn't apply. Everybody's different. They can be generally applied, across the board. But like I said, that's why they call it personal money management. It is personal to you. Understand what works for you and stick to it. That's the main important thing. Map out a plan for you. Know where you are. Know where you're going, and then know what's best for you. And you should be all right. Hey, Dope.
Hey, Bob, the only one we're missing is where we're talking about doing the work to understand what works for you, what the rules of the game are, and know where you're going. It takes work to build wealth. Don't think it's easy. It's not simple.
Hey, Dope, I bet you didn't catch the graph that I'm using. You know what that is?
I see it rolling the dice, but I don't know what that is on the right.
That's the little pig. You remember the game Sorry?
And no, I never played that.
Remember the game Life?
Never played that. No.
This is like you rolling the dice and you're trying to find where to go, how you ended up going. You don't remember that game? Okay, never mind. Well, I know sometimes a little bit deep for you. My bad.
It
is. Oh, wow. Look, everybody. That was a lot of information. Thank you all. Stay tuned. Roll call, Modestine in Lexington, South Kakalaki. Glad you're there. Call Chapman. How are you, my good brother? Nolia, my sister. My sister Linda is not on here today. She went to see the Dolphonics I thought all of them were dead, but I don't know if she went to the cemetery to hear them or something. But they supposed to be at the Blue Dolphin, you know. Garnett, what's up, Garnett? What's going on? How you doing, dearest? And Joe Ann Skinner, James Alexander. So glad to see you. I did mention my sister Nola. She's bringing up the rear for the Kinzer family. Thank y'all for tuning in. We'll be here next week, 156th show. And I'm sure we have a great topic for you. Remember, put in that comment box some topics you'd like for us to talk about. And Doe, I just want to leave you with the quote of the week.
Okay.
Never blame someone for the road you're on. That's your own asphalt. Have a good day, ladies and gentlemen. Later, Doe. You said you're going to start screening me.
Yeah, we got to edit. That was okay. I like that one.
Okay, thank you very much. That's very clever. Have a good one, y'all. The FITT Show, financial information for today and tomorrow, Thursdays at 8 p.m.